Welcome to our discussion on discretionary loan trusts. We'll explore their structure, suitability, tax advantages, and the RISAF principle in estate planning. A discretionary loan trust involves the settlor making an interest-free loan to trustees, typically for investment. The loan remains part of the settlor's estate, avoiding immediate inheritance tax charges. Growth beyond the loan value is outside the estate. Trustees can distribute income flexibly, and the settlor can recall the loan anytime, ensuring flexibility. A discretionary loan trust offers immediate inheritance tax mitigation, as growth beyond the loan is outside the estate from day one. The estate value reduces over time with loan repayments, lowering inheritance tax liability. The settlor retains access to the loan, ensuring cash flow flexibility. No initial tax charge occurs, and trustees can adapt distributions to suit family needs. Discretionary loan trusts involve loans, not gifts, avoiding immediate inheritance tax. They offer full loan recall, high flexibility, and are unaffected by health. In contrast, discounted gift trusts involve gifts, require medical underwriting, and have fixed withdrawals. Discounted gift trusts remove discounted value from the estate immediately, but health can impact the discount. A discretionary loan trust is ideal for individuals with inheritance tax liabilities needing capital access, those in poor health, and clients wanting control over withdrawals. It's less suitable for those needing to give away capital entirely, with minimal inheritance tax exposure, or where care costs consume the estate. Appointing suitable trustees is crucial. Consider adult children, trusted family, or professional trustees for larger trusts. Trustees must act in beneficiaries' best interests, invest prudently, and maintain accurate records. They should be United Kingdom residents to avoid complications and must not be under 18 or of unsound mind. Ideally, appoint at least 2 trustees. Beneficiaries can include children, grandchildren, other relatives, spouses, unmarried partners, charities, and specified individuals. However, the settlor and usually their spouse cannot benefit, as this would be considered a gift with reservation. Keeping assets in the estate for inheritance tax purposes. Companies controlled by the settlor are also excluded. Creating a trust offers immediate tax advantages. No inheritance tax charge occurs as a loan, not a gift, is made. Growth on investments is outside the estate, avoiding 40% inheritance tax. Investment bonds defer income tax and avoid capital gains tax events. Future benefits include reduced estate through loan waivers and minimized inheritance tax charges on death. The RISAF principle allows for significant inheritance tax savings by settling multiple trusts on different days. Each trust benefits from its own nil rate band, unlike a single trust which incurs a higher inheritance tax charge. By splitting £1 million across 4 trusts, each within the nil rate band, periodic charges are minimised or eliminated. To apply the RISAF principle, settle each trust on different days to avoid related settlements. Establish each trust with a nominal amount, separate deeds and accounts. Typically 3 to 5 trusts are used. Timing is crucial. Set up trusts before loans. Each trust files its own inheritance tax returns, increasing administration but offering significant tax savings. A discretionary loan trust offers no potentially exempt transfer or chargeable lifetime transfer risks, immediate inheritance tax protection on growth, and flexibility with loan recall. It's suitable for those in poor health as no medical underwriting is needed. However, the settlor cannot benefit to avoid a gift with reservation. Using RISAF, multiple trusts can maximize nil rate band benefits. This presentation is intended for financial advisors and professionals only. Tax rules and legislation can change, and the information is based on current Her Majesty's Revenue and Customs practice. The RISAF principle should be implemented with qualified advice. Investment returns are not guaranteed, and individual circumstances vary. A full assessment and written recommendation are essential.